right now, a commercial truck driver can actually fail a hair follicle test for hard drugs at a major carrier and then just walk right across the street, pass a standard federal urine test, and legally drive an 80,000-pound semi-truck right next to your family on the highway.
Yeah, it's a completely wild loophole.
It is. And that massive kind of hidden regulatory loophole is currently turning the entire U.S. supply chain completely upside down.
Absolutely.
So whether you are, prepping for a logistics strategy meeting today, or you're simply curious about how the actual goods you purchase get to your local store shelves, this deep dive is going to fundamentally change how you view the highway. Welcome.
Glad to be here.
We are looking at the absolute backbone of the economy today, and it is going through a seismic structural shift.
It really is. I mean, the freight market is the ultimate leading indicator for the broader economy.
Right.
Changes here, they ripple outward so rapidly. When we see fundamental rewiring of how goods move, and specifically when the baseline cost to move a pallet of goods goes up, your wallet is going to feel that impact.
Oh, almost immediately at the checkout counter.
Exactly. The underlying mechanics of supply and demand in trucking, they basically dictate the pricing power for almost every physical product in the market.
So to get into this, our source material today is the Q1 2026 earnings call for Knight-Swift Transportation.
Ticker symbol KNX.
Yep, KNX. They operate as one of the largest freight transportation companies across the U.S. and Mexico. And the mission for this deep dive is to look way past the dry financial metrics and, operating ratios.
Right, because buried inside the nuance of this earnings call is a massive regulatory cleanup.
A cleanup that is currently stripping capacity out of the market at a staggering rate. So, okay, let's unpack this, because after a grueling, 3+ year down cycle for the trucking industry, the leverage is finally shifting back to the asset-based carriers.
It is. And to understand the magnitude of that shift, we really have to analyze the immediate trigger that exposed just how fragile the freight market had actually become.
Right, the Q1 numbers.
Yeah. In the first quarter of 2026, Knight-Swift reported essentially flat revenue year over year. But their adjusted earnings per share dropped to 9 cents.
Which was down from 28 cents the previous year.
Exactly. A huge drop. And that compression was driven in large part by a severe weather event.
Yeah, looking at the breakdown in the call, they took an estimated $12 to $14 million net negative hit purely from those severe January winter storms that swept across the Southeast.
And that was compounded by spiking fuel costs at the exact same time.
Right, but winter weather happens literally every year.
It does.
So what makes this specific storm so crucial to the narrative is that it didn't just, delay a few dispatch schedules. It caused an immediate acute tightness in the spot market essentially overnight.
Shippers found themselves completely stranded. That sudden lack of capacity is the critical takeaway here. When that storm hit, the spot market suddenly just evaporated. And Knight-Swift, leveraging its massive scale, keeping in mind that roughly 70% of their fleet is deployed in one way, over the road service, they were able to step in and absorb that displaced freight.
Because the marginal carriers simply failed to perform.
Exactly. The storm acted as a literal stress test for the entire industry.
It makes me think about the freight market over the last 3 years. It's been operating like a shock absorber that was slowly and silently stripped of all its hydraulic fluid.
That is a great way to put it.
Right. Because to an outside observer looking at the sheer volume of registered DOT numbers, it looked perfectly stable. There appeared to be plenty of trucks and incredibly cheap rates.
Oh, dirt cheap.
But that January storm proved there was absolutely zero functional slack left in the system.
None.
The very moment actual operational pressure was applied by a weather event, that shock absorber completely bottomed out and just shattered the axle.
What's fascinating here is how this exposes the mechanics of the bullwhip effect in a post-pandemic supply chain.
Okay, tell me more about that.
Well, during the pandemic boom, we saw a massive influx of cheap capacity flood the industry. Retailers were over-ordering to compensate for supply chain delays, right?
Yeah, everyone was panic buying.
Exactly. Which created an artificial surge in freight demand. In response, basically anyone who could secure financing bought a truck.
Right, naturally.
But as consumer demand normalized, retailers slammed on the brakes. And that caused a violent contraction in freight volumes upstream.
So that's the bullwhip effect in action.
Exactly. A small correction at the retail level creates a massive amplified swing in the trucking sector.
Which left the industry with an enormous glut of trucks chasing a rapidly shrinking pool of freight, driving rates into the ground for 3 solid years.
Precisely. And that's the exact environment that masks underlying instability. That oversupply was an illusion built on completely unsustainable economics.
Because they couldn't afford to keep it up.
Right. Marginal carriers were operating at a loss, deferring critical maintenance, and barely scraping by. The January storm was simply the catalyst needed to prove that the bottom of the market had finally fallen out.
The excess capacity just couldn't withstand even a minor external shock.
Yeah, and leverage violently shifted back to the massive, reliable carriers, the ones who actually had the balance sheets to weather the storm and keep their fleets moving.
So the weather was the spark. But as we dig deeper into this earnings call, it becomes incredibly clear that the real reason the market is tightening so violently right now is a structural removal of supply.
Yes.
Like, trucks aren't just parked because of snow anymore. They are actively being forced off the road by regulators.
This is huge. The Department of Transportation and the Federal Motor Carrier Safety Administration, the FMCSA, they're currently executing a massive regulatory cleanup.
Finally.
Yeah, they are actively revoking invalidly issued non-domicile commercial driver's licenses, and they are aggressively auditing and shutting down non-compliant truck driving schools.
The ones that have just been churning out unqualified drivers.
Exactly.
You know, Knight-Swift CEO Adam Miller, he specifically highlighted the government's crackdown on what he called chameleon carriers.
Oh, the chameleon carriers, yeah.
And for anyone unfamiliar with the mechanics of that fraud, these are bad actors who run up terrible safety scores, fail inspections, and face skyrocketing insurance premiums.
Right.
And instead of actually fixing their operations, they just shut down their corporate entity, apply for a new DOT number under a different name, and literally reopen the next day as a quote-unquote new carrier with a clean record.
It's unbelievable.
They fake their driver logs, they pay well below livable wages, and that allows them to chronically underbid legitimate carriers.
And the closure of those loopholes is draining a significant amount of shadow capacity from the market right now.
Yeah.
But the most crucial detail brought up in the call, and honestly the one that highlights the massive discrepancy in safety standards across the industry, is the ongoing debate around drug testing.
Right. Going back to what I mentioned at the start.
Exactly. Knight-Swift has utilized hair follicle testing for over a decade, entirely voluntarily.
Wow.
Voluntarily.
Yeah, and they noted on the call that their internal hair tests catch roughly 14 times more drug users than the standard federally mandated urine tests.
14 times more. I mean, I was looking closely at the discrepancy in that drug testing data, and it creates a terrifying operational loophole.
It really does.
Because the federal government currently only recognizes urine analysis for the National Clearinghouse, an applicant can test positive for hard drugs on Knight-Swift's hair follicle test.
Yep.
And Knight-Swift is legally unable to report that failure to the National Registry.
They can't do anything about it.
So the driver simply leaves, passes a basic urine test at some less stringent carrier down the road, and immediately gets behind the wheel of an 80,000-pound vehicle. Wait, so someone can fail a hair follicle test for hard drugs at Knight-Swift, but then just walk down the street, pass a basic urine test, and legally drive a massive semi-truck right next to you on the highway? That is exactly what happens. The current federal framework essentially penalizes carriers who implement higher safety standards.
That is insane.
It allows the rejected, unsafe drivers to just go work for their cheaper competitors. Knight-Swift is actively advocating for the ability to at least report their positive hair follicle tests to the National Registry.
Which seems like the bare minimum.
Right. They specifically referenced LA's law on the call as a potential legislative fix that would codify these stricter safety standards into law, systematically preventing those drivers from slipping through the cracks and migrating to marginal carriers.
Okay, so looking at this purely through an economic lens, the removal of these drivers and the crackdown on chameleon carriers fundamentally alters the baseline math of the entire supply chain.
If we connect this to the bigger picture, you can see how this regulatory cleanup shifts the entire supply curve.
Right.
By fleshing out non-compliant carriers and unsafe drivers, the government is essentially removing the absolute cheapest capacity from the market.
Because it shouldn't have been that cheap to begin with.
Exactly. For years, these actors artificially depressed freight rates by ignoring safety protocols, avoiding insurance premiums, and skirting labor standards.
Yeah.
When you evaluate the market reality independently of the politics behind the administration's regulatory push, the baseline cost to move freight is fundamentally rising, The cheapest, least compliant options are literally being regulated out of existence,
forcing shippers to rely on carriers who bear the full, legitimate cost of operating safely.
Precisely.
And the ripple effect of that structural capacity reduction is hitting the shipping community hard right now. Bid season is in full swing, and the earnings call paints a picture of absolute chaos on the shipper side.
Complete chaos.
We are seeing a massive spike in what the industry calls turnback bids.
And the increase in turnback bids is the clearest indicator of a rapidly tightening market.
Explain how that works for us.
Sure. So a carrier will participate in a routing guide bid, they'll win the contract, and then flat out reject the award a few weeks later.
Oh, wow.
Yeah. The carrier's pricing team looks at the contract they just won and realizes the spot market has moved so fast that the rates they proposed just a month ago are already underwater.
So they just walk away.
Right. The opportunity cost of dedicating a truck to that outdated contract rate is simply too high when they can deploy that same asset into the spot market for a significant premium.
And shippers are realizing their routing guides are breaking down because for the last 3 years, shippers had all the leverage.
All of it.
They would routinely issue opportunistic off-cycle bids just to squeeze carriers and drive prices down another few pennies per mile.
Yeah, just brutalizing the carriers.
But now that behavior has completely stopped. They are purely focused on securing guaranteed capacity. Knight-Swift management noted that they are already engaging in unprecedented early discussions with customers for peak season demand.
Way earlier than normal.
Yeah. Shippers are looking at the Q4 holiday rush and realizing that if they don't lock in trucks right now, their freight simply won't move.
The shift in pricing power is absolute. Because of that justifiable fear from shippers, Knight-Swift has drastically revised its bid targets upward.
Oh, yeah.
Just 1 quarter ago, their strategy was aiming for low to mid single-digit rate increases. Now they are aggressively targeting high single to low double-digit percentage increases across their contractual portfolio.
Here's where it gets really interesting because the behavior of shippers right now is basically a frantic, high-stakes game of musical chairs.
I love that analogy.
It really fits. During the down cycle, there were far too many cheap chairs available. Shippers could sit wherever they wanted, reject dedicated capacity, and rely on broker apps for pennies on the dollar.
Yep.
Now the music is stopping. The DOT and FMCSA are actively confiscating the cheap chairs.
They're taking them away.
And shippers are absolutely terrified of being left standing. So they are running back to major asset-based carriers and willingly paying double-digit increases to guarantee they have a premium Knight-Swift chair locked in before the capacity runs out entirely.
And that dynamic is exactly why shippers are showing such a massive preference for asset-based carriers over pure brokers right now.
Makes sense.
When capacity gets tight, shippers want the security of knowing the company they hired actually owns the physical truck showing up at their dock.
They don't want a broker scrambling to find a random driver on a load board.
Exactly, because that driver might reject the tender at the last minute. Knight-Swift is strategically pivoting to capture this exact flight to quality. They actually cut the number of third-party logistics carriers they work with internally by 30% just since the beginning of the year.
Just to ensure absolute quality control and mitigate risk.
Exactly.
Which really speaks to their overarching strategy. Despite the spot market rates exploding due to this capacity crunch, Knight-Swift only maintains a low to mid-teens percentage of spot market exposure.
Right. They aren't chasing the volatile, quick revenue in the spot market.
No, their absolute priority is locking in massive volumes of contractual business at these newly elevated rates to secure long-term yield.
Because contractual freight provides the predictable velocity required to maintain a stable national network.
Right.
And this brings us to a crucial logistics cycle concept regarding their third-party brokerage segment. During the early stages of a market inflection point like this, the logistics side actually faces severe margin compression.
And the mechanics of that margin squeeze are fascinating. When spot capacity tightens, the cost for a broker to hire a third-party carrier spikes immediately.
Yep.
But the broker is still legally bound to charge the shipper the older, lower contractual rate until those annual contracts expire and can be renegotiated.
The buy rate goes up instantly, but the sell rate is stagnant, completely crushing the margin.
Yeah, rough spot to be in.
However, as those contractual rates systematically reset higher throughout this current bid season, that logistics segment will eventually catch up. And then they'll experience a massive boom in profitability.
Ah, okay.
Knight-Swift is positioning both its asset-based fleet and its logistics segment to catch the wave. But the timing of when each segment hits peak profitability is staggered by design.
But having newfound pricing power in the market doesn't really matter if your margins are bleeding from the inside due to operational bloat.
Sure.
Knight-Swift had to make sure their internal network was fully optimized to capture this upcycle. Which brings us to the massive internal optimization efforts surrounding the recent acquisition of U.S. Xpress.
Oh, the integration of U.S. Xpress was an incredibly complex undertaking. Merging corporate cultures, dispatch systems, and maintenance protocols is notoriously difficult in the truckload sector.
Yeah, I can only imagine.
Knight-Swift made several aggressive, calculated moves, the most notable being deliberately shedding several thousand tractors from the U.S. Xpress fleet since the acquisition closed.
And the operational data behind that decision is telling. It turned out that prior to the acquisition, roughly 40% of U.S. Xpress loads were being sourced from third-party brokers rather than direct shipper relationships.
Yeah, relying on brokers for 40% of your freight is an entirely unsustainable model for an enterprise-level carrier.
It's massive.
It means you lack direct relationships with the actual shippers, leaving you at the absolute mercy of spot market volatility, while a middleman constantly shaves off a percentage of your yield.
Right, you're just giving away margin.
Exactly. Knight-Swift recognized this structural flaw immediately. They aggressively purged that broker-dependent volume from the network, which naturally meant they didn't need the excess tractors that were previously hauling that low-margin freight.
They also overhauled the safety culture at U.S. Xpress. By implementing Knight-Swift's stringent safety standards, they improved the CSA crash basic score at U.S. Xpress by over 60%.
That's a huge jump.
It is, and that translates directly to massive cost savings in terms of insurance premiums, liability exposure, and equipment downtime. There is still a roughly 300 basis point gap in the operating ratio between U.S. Xpress and the legacy Knight-Swift brands, but the trajectory shows that gap is rapidly closing.
We see similar optimization execution in their less than truckload or LTL segment too.
Yeah, let's talk about the LTL side.
Well, the LTL division took an $18 million hit to the financials due to an adverse arbitration claim. But when you look past that isolated event, the underlying operational metrics were exceptionally strong.
Extremely strong.
They achieved a 5.2% increase in weight per shipment and an 8.5% increase in length of haul.
Those metrics signal a highly successful strategic transition. Moving heavier shipments over longer distances means they are successfully evolving from a fractured regional LTL network into a cohesive national network, right, allowing them to attract blue-chip industrial customers who yield significantly higher margins. So what does this all mean?
Raul.
Let me push back on the core strategy regarding the U.S. Xpress truckload division for a moment.
Okay, sure.
Because we just spent this entire analysis detailing how the market is violently tightening, capacity is draining out of the system, and shippers are absolutely desperate for guaranteed trucks.
Right.
In that environment is deliberately shedding thousands of tractors right before a massive upcycle, a strategic misstep. Like, why reduce capacity when demand is peaking?
This raises an important question, and it cuts to the core of advanced freight economics. It appears counterintuitive to shrink your asset base when market demand is rising.
Right. You'd think you want more trucks.
But the operational reality is that it is infinitely more profitable to run a smaller, highly efficient fleet with safely seated tractors, hauling high-yield direct relationship freight, than it is to carry the massive capital expenditure and maintenance overhead of empty trucks waiting around to haul cheap, broker-dependent loads.
Ah, okay.
Quality of freight and asset utilization always trump sheer fleet size.
And the utilization data entirely supports that strategy. The CFO specifically noted on the call that despite operating thousands of fewer physical trucks right now compared to a year ago, Knight-Swift is actually running more total miles today than they were prior to the last market upcycle.
They are achieving greater velocity and higher revenue per tractor by stripping out the operational friction.
Wow.
Their ultimate goal across the entire truckload business is to push the operating ratio back down to a normalized mid-80s target.
That's the dream.
That is the holy grail of profitability for an asset-based carrier of this size. And stripping the broker-dependent bloat out of U.S. Xpress was the necessary surgery to get the consolidated enterprise back on that path.
It is incredible how all these macro and micro elements align. We started with a localized winter storm in January that, on the surface, seemed like a standard temporary blip in the supply chain.
Yep.
But what it actually did was shatter the illusion of oversupply. It exposed a freight market where all the functional slack had been secretly drained out by a massive, ongoing government regulatory cleanup that is structurally removing the cheapest, least compliant carriers from the road.
A cleanup that is fundamentally shifting the supply curve and placing pricing power firmly back into the hands of major, highly compliant, asset-based carriers who have the scale to guarantee capacity when routing guides fail.
And for you listening, this is where the macroeconomic theory meets your daily reality. Those high single to low double-digit freight rate increases that Knight-Swift is currently locking into multi-year contracts with desperate shippers, they aren't just abstract data points on a financial spreadsheet.
Definitely not.
Those freight rates are the literal future prices of the groceries, the electronics, the clothing, and the manufacturing components you are going to purchase later this year. When the baseline cost of the truck goes up, the retail cost of everything sitting inside that truck goes up with it.
It is the inescapable math of the physical supply chain.
Yeah.
But I want to leave you with one final lingering thought to consider, which brings us all the way back to the regulatory debate surrounding the National Clearinghouse.
Oh, the hair follicle testing.
Exactly. We know from Knight-Swift's own internal data that their hair follicle testing catches 14 times more drug users than the current federally mandated urine tests.
14 times. Still blows my mind.
The industry is already experiencing a severe capacity crunch, and carriers are scrambling to recruit safe, compliant drivers. So, what happens to the U.S. economy if the government actually passes Lalle's law and makes hair follicle testing mandatory nationwide?
The immediate disqualification rate would send an unprecedented shockwave through the system.
Right. Will that sudden, massive disqualification of commercial drivers cause store shelves to simply go empty because there is literally no human capital left to move the freight?
Oh.
Or will that immense, unbearable pressure on the labor pool finally force the entire trucking industry to leap fully into a new era of autonomous, driverless automation out of sheer necessity?
That's a fascinating point.
It is definitely something to think about the next time you pass a semi-truck on the highway.
Absolutely. Well, that wraps up our deep dive into the shifting gears of the freight market. Thanks for listening, and keep your eyes on the road ahead.